Open your phone during any festival or wedding season, and you will see the same promises flooding your screen. Instant cash, pre-approved, money in your account in 5 minutes. The marketing makes it look like borrowing capital is as easy as ordering takeout. But an unsecured personal loan is a strict transaction. Because the bank holds no collateral, no house, no car, no gold, they have zero leverage if you stop paying. They have to rely entirely on your historical financial discipline. Lenders do not care about the urgency of your medical bill or the deadline for a wedding vendor. The system evaluates one thing exclusively: the statistical probability that you will default on the debt. This flowchart maps out available paths for capital. Without a secured loan, you enter the unsecured loan algorithm. Here, odds drop. Banks approve just 10 to 15%. NBFCs take more risk, approving 18 to 24%. The vast majority funnel directly into outright rejection. Applying blindly across multiple apps hoping one sticks is actively harmful. Every time you hit submit, the lender triggers a hard inquiry on your credit file. Stack up too many of these in a short window, and the algorithm assumes you are desperate, pulling your score down and locking you out of future borrowing. To navigate this system safely, you need to understand the math. We are going to break down the exact thresholds lenders use so you can calculate your odds before you ever hit apply. Getting approved isn't about how badly you need the money. It's entirely about how perfectly you fit into the lender's risk matrix. Every financial institution follows a standard operating procedure, a strict 5-pillar checklist that your application must survive. Let's look at the first half of that process. This graphic shows the sanction algorithm in action. Step 1 is basic identity verification. Lenders cross-reference your PAN, Aadhaar, and CKYC records to immediately filter out synthetic identities and fraud. This chart shows how your credit score dictates your lender options. A CIBIL score of 750 or higher allows you to access Tier 1 banks, where interest rates are at their lowest and loan limits are at their highest. Drop below 650 and you trade away bank access. You are either pushed into high-interest NBFC loans or the system simply rejects you. Step 3 is the strictest filter, the debt-to-income ratio. Lenders mandate that your total monthly loan payments never exceed 40 to 45% of your net take-home pay. Looking at this bar chart, the math is clear. If you earn $4,000 a month and you already pay $1,500 in existing EMIs, you are sitting at a 37.5% DTI. You have almost hit the ceiling. If your debt-to-income ratio is maxed out, a perfect credit score cannot save you. The algorithm flags that you lack the available cash flow to handle another monthly payment, and your application is denied. Your past financial discipline gets your application through the door. Your current available cash flow dictates whether you actually walk out with capital. Returning to our scorecard, the fourth check evaluates stability. Lenders want to see predictability, usually a minimum of 1 year at your current salaried job, or 2 years running the same business. Who you work for matters just as much. Employment at a reputed multinational corporation or a public sector undertaking actively lowers your internal risk score, smoothing the path to approval.
Freelancers, gig workers, and people who change jobs frequently face the opposite reality. Lenders demand intensive documentation, like 2 years of tax returns and 6 months of bank statements, to prove your income isn't going to suddenly dry up. The final check is your day-to-day account conduct. If the bank sees a recent history of bounced checks or heavy reliance on overdraft facilities, the application is flagged immediately. Knowing how strict this process is, many borrowers try to bypass the banking SOP entirely by turning to instant NBFC apps. This comparison matrix highlights the trade-off. Getting capital wired to your account in 24 hours requires you to accept conditions that traditional banks don't impose. The cost of speed is steep. You will often see processing fees of 1 to 3% taken right off the top, and if you miss a payment, you are hit with a punishing penal interest rate of 2 to 4% per month. You also need to watch for bundled life or accident insurance policies that aggressive salespeople will try to slip into the agreement, inflating the total amount you owe. In the world of unsecured lending, convenience is never free. Speed exacts a toll through hidden fees and punitive terms. Banks use these criteria to sort applications, but you must use them to select your lender. Applying to the wrong institution can trigger a cycle of rejections that damages your credit file. This quadrant chart plots your options. Leverage is determined by credit discipline on the horizontal axis and income stability on the vertical. Top right, with a CIBIL score above 750 and stable corporate income, you are the optimizer. You hold the leverage here. You should demand Tier 1 bank rates. Explicitly tell the lender to remove any bundled insurance and negotiate the processing fees down to 0 before you sign. Moving to the bottom right, we have the borderline earner. You have a strong credit score, but your income comes from freelance work or gig contracts. Traditional banks will likely reject you over income volatility. NBFCs are your most realistic path, but you must aggressively verify their foreclosure terms and prepayment penalties to ensure you aren't trapped in the loan. In the top left is the credit builder. You have a stable job, but your credit score has dropped below 650. Stop applying for unsecured loans immediately. The algorithms will keep rejecting you. Instead, take a secured loan against gold or a fixed deposit and pay it off reliably for 6 months to rehabilitate your CIBIL score. Finally, the bottom left is the high-risk profile: low credit, unstable income, and high existing debt. Taking a new loan at 24% interest to cover old debt is a mathematical trap. Avoid personal loans completely and seek professional debt restructuring instead. Regardless of where you land on the matrix, if you do borrow and encounter aggressive recovery agents using unethical pressure tactics, document the behavior and file an immediate complaint with the RBI Ombudsman. Stick to the strict math. Keep EMIs under 40%. Read the agreement yourself and ignore verbal sales promises. A personal loan is a tool for short-term liquidity. It is not to inflate your lifestyle. Calculate your position, weigh costs, and only sign the agreement when the numbers make sense.